We welcome back into the studio Grant Patterson from Providence Wealth. Now, Grant, what a time to be in markets. Now, is a geopolitical crisis a great time to stress test your portfolio so you can sleep at night?
Well, I think, geopolitical moves and the impacts on markets is very hard to really understand and really get on top of. It's a lot of noise, a lot of distraction. My view on it is that if markets are good value and valuations are attractive, then markets tend to hold up okay despite what might be going on around the globe. And that's not, taking any sort of view about what is going to occur. So my view on that is that it's a distraction, it's a tragic event that's occurring, but as far as markets are going, they were ripe for a correction. Irrespective, I was talking here, last year with you about some of the valuations, and we've started to see those tectonic shifts occur since the beginning of January this year.
A lot of the indices have held up relatively well given the circumstances. So from a valuation perspective, does that tell you that a lot of that that revaluation has actually gone and occurred?
Well, the indices have held up pretty well, but within the indices, there's been a lot of carnage. Within the Nasdaq, for example, 50% of the stocks are down by more than 50%. The average company in the Russell 3000, a much broader market, is down by 20 to 30%. So there's a bear market that's occurring within the indices, and it depends very much on what stocks you're in. So we're starting to see for the first time a divergence, a real divergence in performance of fund managers, divergence in markets, divergence of stocks, and that's why, in our view, active management is going to be a really, really important part to protect your portfolio going forward.
Yeah, that's what I was just saying. We were talking earlier, like passive investing is not the time. So do you just look for like bargains? Like when you have a contagion day, is that when you think, oh, it's time to, I hate to say buy the dip, but is it time to look at quality names that may be caught up in the wash?
Yeah, I think so. I mean, the US tech stocks, for example, you've had ARK, the ETF, down, 50%, Berkshire Hathaway's up 34%, there's these sort of movements. And so when you start getting such great big divergence, you need to have a look within that. So in the US small cap tech stocks, a number of those stocks are now trading at cash backing. Now that looks to me a potential opportunity that we need to keep an eye out for. So yes, you need to pick where you want to be, your sectors you want to be, and we believe that valuations do matter in the end, and they can adjust very quickly, which we've seen since the beginning of January.
We'll get to what you've been doing with your portfolio in just a minute. What I'm going to ask you about what the signals the bond market is telling you, not only about the outlook for growth and inflation, but no risk aversion at the moment.
Yeah, well, it's our view that the tide is changing, and I don't think everyone's really got this just yet. Inflation was supposed to be transitory, and now it's not. And it's still posting 6 and 7%. And the Fed are saying that things are going to settle down and it's all okay. Well, we're not quite sure about that, particularly with energy prices. And we see a sustained period of higher highs and higher lows in inflation. So the market's got, trying to adjust to that. Now we've seen that at the short end of the curve, the 2-year, but the long end of the curve is got a different story. So global growth is very strong. We're seeing that. Inflation is elevated. The bond market at the short rate's going up. But the longer end of the bond market is much more subdued. It's sort of talking about a potential slowdown. And I would not rule out, or we would not rule out the potential of a significant downturn in global economies in 2024. And if you're investing now for the medium to long term, you've got to start thinking about what does the world look like in 2 years' time.
So what do you avoid then with that 2-year outlook?
Well, I'd certainly avoid unlisted illiquid investments that are going to mature in 2 or 3 years' time. So I'd like to go through the cycle and so have longer dated sort of illiquid investments, if you like. Within that, you just want to make sure that you've got some inflation protection in your portfolio. So retail shopping centres are a very good example where they're able to have some sort of inflation protection. In the property trusts, you want to make sure that the rental increases are CPI linked, not fixed, which we've seen for the last sort of 10 years. Because everyone said inflation was never going to be a problem, so we'll just get 2% or 3% per annum. So those sort of areas, I think you got to watch.